Welcome to the Investors Trading Academy, talking glossary of financial terms and events. Our word of the day is acid test. Current cash and near cash assets, such as government bonds, current receivables, but excluding inventory compared to current debts like bank loans, payables. The acid test shows how much and how quickly cash can be found if a company gets into trouble. The acid test ratio is a strong indicator of whether a firm has sufficient short-term assets to cover its immediate liabilities. Commonly known as the quick ratio, this metric is more robust than the current ratio, also known as the working capital ratio, since it ignores illiquid assets such as inventory. Companies with an acid test ratio of less than 1 do not have the liquid assets to pay their current liabilities and should be treated with caution. If the acid test ratio is much lower than the current ratio, it means the current assets are highly dependent on inventory. This is not a bad sign in all cases, however, as some business models are inherently dependent on inventory. Retail stores, for example, may have very low acid test ratios without necessarily being in danger. At the time of writing, Walmart Stores Inc.'s WMT acid test ratio is 0.20, while Target Corp's is 0.40. The company's current ratios are 0.90 and 1.20 respectively. In such cases, other metrics should be considered, such as inventory turnover. The acceptable range for an acid test ratio will vary by industry, and comparisons are most meaningful within a given industry.